In 2008, the world didn't just witness a financial crisis, it witnessed the moment a hidden machine deep inside the global economy finally snapped. A machine built on toxic debt, fake safety labels, and trillions of dollars in invisible bets, all chained together in ways almost nobody understood. This wasn't a housing bubble. It was a system designed to collapse the moment one small piece failed, and when it did, the entire world fell with it. Picture a street in the early 2000s. Freshly built houses with identical roofs, for sale signs with sold stickers slapped on them in a matter of days, SUVs in every driveway, neighbors bragging about how much their home value went up in a year. In the kitchen, a couple sits at a table covered in glossy brochures. They are not sure they can afford the house. But the mortgage broker across from them is all smiles. "Don't worry," he says. "The payment will be low at the start. You can always refinance later. Real estate only goes up." They sign. Now zoom out from that street. The same scene is happening in thousands of suburbs across America, and then in other countries whose banks decided they wanted in on the action. Cheap money, easy approvals, and a cultural belief that owning a home, any home at any price, was the path to wealth. It felt like a golden age. But if you step into a different part of the economy, it looks very different. In downtown financial districts, far from those cul-de-sacs and driveways, you have office towers lit up at midnight. Inside them, teams of bankers and quants are staring at screens filled with numbers and probability curves. They are asking a very specific question: how do we turn all of those mortgages into something we can sell to the entire world? To understand why that question mattered so much, you have to start with interest rates. After the dot-com bubble burst in 2000 and the September 11th attacks in 2001, central banks cut interest rates aggressively to keep economies from stalling. Saving money in a bank account suddenly paid almost nothing. Borrowing, on the other hand, became extremely attractive. Picture a graph of interest rates sliding down like a gentle ski slope. Every step down pushes people and institutions in the same direction, away from safe, boring assets and toward anything that might offer a higher return. Households started borrowing more to buy homes. Developers borrowed more to build them. Private equity firms borrowed more to buy companies. And large investors, pension funds, insurance companies, foreign banks, all began searching for products that could give them higher yields without, supposedly, higher risk. That is where mortgages walked into the spotlight. Mortgages felt solid. They were backed by homes. They had decades of historical data. People paid them before almost anything else. On paper, they were the perfect ingredient for a new era of financial engineering. Traditionally, a mortgage stayed on the balance sheet of the bank that issued it. The bank lent you money, you paid it back over 30 years, and the bank earned interest along the way. That model is slow, it ties up capital, and it limits how much profit a bank can squeeze out of its lending machine. So Wall Street changed the model. Imagine a conveyor belt running through the financial system. At the start of the belt, local lenders and mortgage brokers shove on every home loan they can create. It does not matter if the borrower is perfect, average, or obviously risky. The broker gets paid when the loan is made, not when it is repaid. Those loans are then packed together into giant pools. Thousands of mortgages tied to thousands of houses in dozens of cities. On the next stop of the conveyor belt, investment banks slice these pools into layers called tranches. The top slices get paid first and are labeled as very safe. The bottom slices absorb the first losses and are labeled as risky but high yield. Finally, those slices are wrapped into securities, tradable products called mortgage-backed securities and collateralized debt obligations, and fired out into the global market. A mortgage is no longer a relationship between a bank and a family. It is raw material inside a structured product that nobody on the outside can really see. Now introduce the most dangerous ingredient of all, the rating. Rating agencies are supposed to be the referees of finance. Their job is to look at a financial product and say this is safe or this is risky. In the mid-2000s, they began stamping a huge number of mortgage-backed products with the highest possible rating, AAA. AAA is supposed to be reserved for things that almost never fail: government bonds from stable countries, the safest corporate debt, rock-solid institutions. But you can visualize what was really happening like this. On one side of a long table, You have binders full of complex mortgage structures, equations, and default scenarios. On the other side, you have a simple rubber stamp that says AAA. The models used by the rating agencies made one critical assumption. Housing prices might fall in one region, or two, but they would not fall everywhere at once. If that assumption holds, the products really do look very safe. If that assumption breaks, everything collapses. Investors were not buying the underlying mortgages. Many never even looked inside the structures they were purchasing. They were buying the label. And once a product is labeled safe, it can be stuffed into pension funds, insurance portfolios, bank balance sheets, and the reserves of institutions all over the world. Demand exploded. Here is where the whole structure quietly flips upside down. In a sane world, mortgages are created because people need homes. In the pre-2008 world, mortgages were increasingly created because Wall Street needed product. The conveyor belt had to keep moving. If investors wanted more AAA securities, banks needed more mortgage pools. If banks needed more pools, lenders needed more borrowers. So standards dropped. Imagine a lender's office, where the requirements checklist gets shorter month after month. First, you needed full documentation of income, then just a recent tax return, then a stated income without proof. Eventually, in some cases, nothing beyond a signature and a promise. Interest-only loans. Adjustable rate loans with tiny teaser payments that would later explode. Loans where the borrower did not even pay down the principal at the start. Real estate agents saw buyers who, a few years earlier, never would have qualified for a loan now being waved through. As this cheap credit washed through housing markets, prices rose faster and faster. People saw neighbors getting rich on paper and wanted in. Speculators started buying multiple homes just to flip. The feedback loop was complete. More credit pushed up prices. Higher prices made loans look safer. Safer-looking loans justified more lending. And the securities built on top of those loans looked stronger than ever. From the outside, everything looked stable. From the inside, the system looked like a skyscraper built on wet sand. The first signs of trouble did not look catastrophic. They looked like individual families falling behind on payments. An adjustable rate mortgage reset? A job was lost. A medical bill arrived. A teaser period ended and the monthly payment doubled. Picture a mailbox filling with late notices. Phone calls from the bank. A foreclosure notice taped to the front door. A few empty houses on a street do not kill a financial system. But remember what those houses represented higher up the chain. Every missed payment was a tiny crack in a mortgage pool. Every crack weakened the securities built on top of that pool. Every weak security sat on the books of some bank, fund, or institution that thought it was holding something almost risk-free. Investors began to notice rising default rates in the lower quality slices of mortgage structures. For the first time, the word subprime started appearing not as an opportunity, but as a warning. Spreads widened, trading slowed, prices of mortgage-related products dipped. In a healthy system, this would be a signal to reduce risk. In a highly leveraged system, it is something else. The beginning of a chain reaction. Modern finance is built on two invisible pillars: confidence and liquidity. Confidence is the belief that the numbers on a screen correspond to real value. Liquidity is the ability to turn those numbers into cash when you need to. In 2007 and 2008, both pillars began to crack. Imagine a fund manager looking at a position in a complex mortgage security. For years, its value barely moved. It was treated almost like cash. Now, suddenly, buyers disappear. When he tries to sell a small piece, the price drops hard. He calls around asking, "What do you think this is worth?" And here's the worst possible answer in finance: I don't know. Multiply that confusion by thousands of funds and hundreds of institutions. Nobody is sure what anything tied to mortgages is worth. Nobody is sure how much exposure their counterparties have. Nobody wants to lend to anyone for more than a few hours at a time. Short-term funding markets seize up. Banks that rely on rolling over their borrowing every day now face the possibility they will not be able to refinance. A system that looked liquid and safe reveals itself to be brittle and opaque. And then, the pressure reaches the most leveraged players. Think of a large investment bank as a high-rise built on borrowed money. Its day-to-day operations rely on a constant flow of short-term funding from other financial institutions. As long as lenders believe the bank is solid, the funding continues. As soon as doubt creeps in, that funding can evaporate almost overnight. In 2008, that is exactly what happened. One by one, big names that had been symbols of strength began to wobble. Bear Stearns needed a rescue. Lehman Brothers collapsed. AIG required a massive intervention to prevent a wider meltdown. The images from that time are burned into financial history. Employees carrying boxes out of glass towers, stock tickers in freefall, emergency meetings stretching into the night. But what made these failures so dangerous was not just their size, it was their connectivity. These institutions were wired into every corner of the global system through derivatives, guarantees, and off-balance sheet obligations. When one fell, it sent shockwaves through money markets, corporate credit, and even the supposedly safe corners of cash management. For a brief moment, it was not clear whether ATMs would keep working, whether companies would make payroll, whether the basic plumbing of capitalism would hold. That was the true heart of the 2008 crisis. The realization that the system was so interconnected and so dependent on fragile assumptions that failure in one corner could threaten the whole. Faced with that reality, governments and central banks chose the only option they believed would prevent a depression. They stepped in on a scale never seen before. Interest rates were slashed towards zero. Emergency facilities were created to lend directly to banks, funds, and even parts of the corporate sector. Capital was injected into systemically important institutions. Asset purchase programs began that would later be known as quantitative easing. Picture central bank balance sheets expanding like a balloon, swallowing up assets that private markets no longer wanted to touch. On the surface, it worked. Markets stabilized. The panic subsided. Many institutions survived that might otherwise have failed. But the rescue came with a silent cost. By absorbing so much risk and providing so much cheap money, policymakers made the post-2008 world dependent on low interest rates and ongoing support. The system had been patched, not rebuilt. Today, more than a decade later, you can still see the fingerprints of the crisis everywhere. Interest rates in many countries spent years near zero. Central bank balance sheets remain enormous by historical standards. Governments carry far more debt than before. Asset prices, from stocks to real estate, have been pushed up by years of easy money. The specific mortgage products that triggered the 2008 collapse are largely gone. But the underlying incentives that created them, the hunger for yield, the pressure to engineer higher returns, the belief that risk can be transformed rather than reduced, are very much alive. New forms of leverage and complexity have grown in their place, and the memory of 2008 hangs over every major decision in economic policy. Nobody wants to be in charge when the next systemic event happens. The simple story about 2008 is comforting. A bad bubble burst, the culprits were punished, and new rules were written to make sure it never happens again. The real story is harder to look at. The 2008 crisis was not just about housing. It was about a global financial architecture that allowed risk to be buried, multiplied, and mispriced on a massive scale, and about how fragile that architecture became when its core assumption failed. The assumption that house prices could not fall everywhere at once. Modern finance created a tower of promises on top of that belief. When it snapped, the tower shook the entire world. The lesson is not that mortgages are evil, or that markets are doomed, or that every innovation is a scam. The lesson is that when a system becomes too complex for its own participants to understand, and too leveraged to absorb a shock, it will eventually meet a reality it cannot negotiate with. The 2008 crash may be over on stock charts and housing graphs, but the world we live in, the world of low rates, high debts, and constant interventions, is built on its remains. What really caused the 2008 crash was not a single decision, a single villain, or a single bad product. It was the belief that we had finally made risk safe. And that belief, more than anything else, is what turned a street full of ordinary homes into the epicenter of a global earthquake.